And a big welcome to our live audience for Digital Health Investor Talk. I'm your host, Stephen Wardell. I'm the managing partner of Wardell Advisors, a digital health advisory firm, and the author of The Future of Digital Health. Wardell Advisors is helping digital health companies address issues around growth, fundraising, trade sales, and strategic alternatives, giving you more options in today's challenging environment. You can follow me at twitter.com/Stephen Wardell. Our show today is on healthcare go-to-market strategies in 2020. Our guest today is Timothy Dutch Dwight. Dutch is the VP of Health Plan Sales at Wobot, the digital health mental health solution company, and a longtime sales leader selling into health plans and hospitals. This show is being recorded and will be included in my podcast series called Digital Health Investor Talk. Subscribe to our podcast on Apple and Spotify. This is not investment advice, and we are not investment advisors. First of all, here's the format for the show. It's 90 minutes long, and Dutch and I will spend the first half discussing the news and macro picture and other topics. And then for the second half, we'll focus on our topic of the day, which is healthcare go-to-market strategies in 2024. And we'll be taking questions throughout the call in the LinkedIn chat. So, Dutch, welcome to the show. Please introduce yourself.
Greetings, everybody. My name's Dutch Dwight. I have a pleasure of being a sales geek with Wobot Health, and I'm excited to be able to speak to you today. All comments and questions on the LinkedIn profile will be greatly appreciated. Cut me off, jump in, whatever you like. I'm open ears.
That's great. I guess we'll start as we usually do with macro news. The first is I took a trip to New York City last week. And I got to talk to venture investors and other investors and also young digital health company leaders. And the surprising good news I got from that trip is what I'm calling Digital Health Spring. So what that means is that digital health investors who have been sitting on the bleachers and not investing and not leading for a long time, and investment levels have been down for 2 years, they are feeling optimism, and they expect to invest more in the near term, in the next quarter or two. And that's really good news for the innovation economy, for the young company leaders. And the reasons they gave for this, first was that stock market indices are reaching all-time record highs. And second is that funding in adjacent sectors is returning. So a couple of them cited biotech funding has gone from frozen to robust in the last 6 months or so. And lastly, they cited the IPO of Reddit, which Reddit has priced within the last 2 weeks, and it priced at and floated, and it priced at $34 a share. And today it's still up 50% over its pricing, but at the time it had nearly doubled in its value. And so people now, adjacent sectors to digital health are biotech and tech and healthcare services. And here's 2 of those adjacent sectors doing quite well. And so the implication is that in the near term, we could see private investment in digital health companies improve. And you could possibly see some digital health unicorns IPO as well. So, Dutch, any thoughts on fundraising? You probably have been seeing fundraising be very tough in the last 2 years. Are you seeing any changes for the better?
The investors are starting to come out of the woodwork and actively bang on the doors, trying to look for different things in the marketplace. Though that be the case, you still have to have a value proposition that makes sense. So it's practical and revenue focused.
Great. And So the next is, we're also living through this interesting time when major market indices are at near record highs, and that is also creating optimism. So the NASDAQ, I like to track that. The NASDAQ is at 16, which means that it was at 10,000 at the start of 2023. That means in the last 14 months or so, it's been up 63%. So basically, if you really wanted to grow your money and look like a genius investor, all you would have had to do for the last 14 months is put your money in the stock market. And so this week, the market has been somewhat choppy, and it's been down a couple of days this week. and it's on concerns about inflation and rates. The concern about inflation is that it's going to be higher than expected. The concern about rates is that the Fed's not going to cut rates the way people want them to. The market expects the Fed to cut rates 3 times by the end of the year, 3 times by 25 basis points by the end of the year. So this morning, Fed Chairman Jerome Powell said at Stanford that the Fed needs more data and to look more carefully at more data about whether or not inflation is truly calming down in order for the Fed to cut rates according to plan. So that was a note of caution on the part of the Fed, which the markets like certainty, and so this was enough to send markets down and make the market more concerned. So, Dutch, any thoughts on, we certainly would like in the innovation economy to see inflation curbed and rates down, and we had wonderful conditions for 15 years or so, with rates at zero and inflation under control. Any thoughts about, and if we could get inflation down and rates down, we might see funding return and also stock market values for digital health companies be restored to prior levels. Any thoughts on what we'll see from the Fed?
I think you summarized it well there, Stephen. No doubt about it, the rates are impact decision-making. The growth in the stock market will free up some cash. The VCs need to invest it. They can't sit on it forever. They got to lose it. PEs, people are back in the market heavily, looking for opportunities in healthcare, whether that be in facilities management, but it's going to be specialty driven because they're looking at the cash flow from the major government-funded programs, Medicare, Medicaid, dual eligibles, ACA, whatever that case may be. They're looking at that particular stuff. As it relates to the growth, you need to look at which particular programs align with the CMS programs that are out there. So you need to watch that very carefully to see where you're going to put your investment.
Great, thanks. And by the way, this is our first time on a new platform. We used to be on the call-in platform, and now we're using a different tech stack. We're using the Riverside platform combined with streaming to LinkedIn and LinkedIn chat. And I'm seeing right now that we have about 50 guests in LinkedIn, and that's great. That's really great to see that. And for our audience, which I assume is mostly the same audience we've had for years now, but now joining us on LinkedIn, we very much welcome questions. We prioritize questions from the audience. We encourage you to type questions. I just invited in the chat for you to ask questions there. So go ahead and ask questions. Right now we're on the topic of macro news, and feel free to ask us, any macro type questions that you have. And so, we welcome and prioritize questions from the audience. It's great to see so many people in the audience for this show. All right, so moving on to the next topic, we have industry reports. So here we call out whether in the last week or two there have been any important published reports in the sector that people may have missed, and what the key findings of them are. I didn't see any. I'm expecting the Rock Health report to come out for the first quarter of 2020, but it hasn't come out yet, and I'm looking for that. Other than that, I don't have any reports that I want to cite or comment on this week. Dutch, are there any reports that you regularly follow that have findings that you want to bring to our audience?
Yeah, the major reports that I follow are PwC, Deloitte Digital, McKinsey reports that talk directly to what's going on in the marketplace. And citing trends, they interview health plan executives or hospital system executives trying to figure out what's going on. What are the pressures that they are going up through, those prospects, such as, is it cost reduction? Is it workforce optimization? Is it revenue needs? Where's the needle going when it comes to government regulation, and how are they going to be impacted by that? So I watch those particular reports in particular. There are other ones you want to look at that are specific to markets, such as Rebellious Group or Deft Research for Medicare Advantage. There's some great reports coming out of Milliman. Milliman does highlight reports that are impact the government. If you're looking for how to sell into a plan, you need to align with what these people are saying to the marketplace. They research on behalf of plans or on behalf of systems, where the market's going, and give it out in dribs and drabs.
Very interesting, thanks. And for our audience, by the way, if you have questions or if you know of reports that you want us to comment on, feel free to type it in the chat. and we'll bring that to our audience's attention. So now moving on to business news and trade journal news and that sort of thing. And for our audience, if there's any trade journal stories or business news stories you want us to comment on, feel free to comment on it in the chat, and we'll bring it to the attention of our audience here. But big picture with trade journal news, it is sadly still a time of more wind down announcements than fundraising announcements. That's always sad to see, and it's been that way for 2 years now. More disappointing news than optimistic news. But one thing I thought was really interesting was that this morning Costco announced that they will be offering a weight loss program, including modern weight loss drugs like Ozempic and Wegovy. They're doing it by partnering with Sesame, a digital health company, and they'll be selling the program, not including drugs, for about $70 a month to Costco. For about $60 a month to Costco members. Sesame sells the same program to the public for $70 a month. And then this includes the support of a clinician with diet and exercise. But Ozempic costs, or equivalent drugs, cost between $150 and $300 a month. You'd have to add that cost on top of it. And the $150, I got that from Ro's website. And I also noticed on Ro's website that Ro is saying that they have an adequate supply of Ozempic, but they have a shortage of Wegovy. So, Dutch, I can't think of the last thing in healthcare that's had such a big impact as these GLP-1 drugs. There's people in digital health, at providers, in pharma digital health, are all scrambling to figure out how they're going to respond to a drug that's new, that really works for something, which is weight loss. And some people are saying this is going to have a giant, terrible impact on candy makers or illegal drug dealers or other industries, because it seems to zap or reduce people's desire to consume. But so I thought, so Costco getting on board, to me, that represents a mainstreaming of these drugs as an elective drug for the middle class, basically, and mainstreaming the acceptance of this. And I hope there's not a lot of side effects of these drugs, but the primary effect is a very beneficial, positive primary effect. And I hope that's better than any side effects. I hope the side effects are not a big problem in the future. But in general, I call this a success story to have a drug that works, an elective drug that people want, that Costco's now offering you access to. I have friends who are trying to scramble to figure out ways to offer access to this drug to populations, and they're going to be disappointed that Costco's gotten into the act. Now they're competing with Costco of all the crazy things that they didn't think when they went into healthcare. They didn't think they were going to be competing with Costco. But any thoughts on this story about Costco offering diet and programs and medicines?
Well, as it relates to Costco, they're really followers in the sense that, Walmart clinics, if you look at their pricing on a website for Walmart clinics, have been trying to drive the price of products, drug products, dental products, you name it, down to a very low area of affordability. I think this Costco, who is the standard in many areas of food or consumer goods, the standard for the best price or most consistent price across the country. If you go and talk to the health plans or health systems or health plans in particular, this is having a huge impact on their overall cost containment, cost deflection, and benefit design. And by that, I mean that if you're a health plan, you have to take into consideration the cost of this drug, the rebate factors, and whether or not the government's going to require you to include it in your benefit design. Most recently, CMS has agreed to allow it in Medicare Advantage for both diabetes treatment and for cardiovascular treatment. That's a very large step. That's going to make a big difference for it to be able to provide it. But it's also going to impact the benefit design. Under the Inflation Reduction Act, there is a huge question on Part D in particular on how it's going to impact the cost because of the rebate structures within Part D. So if you're anybody out there thinking about digital solutions, and we could talk about Dario Health on Duo or all the other ones that are type 2 oriented, you're going to have to redirect your program and how you go to market. Now, Wegovy is, not the end all beat all. So that everybody's got different conditions. Everybody reacts differently. It may or may not work. The health plans have already a lot of food for pharma programs that are very successful. Virtua is a clear example. So there's a lot of competition. People are going to have to make adjustments in their go-to-market strategy for that. I hope that helps.
Well, I guess the key question would be for our audiences personally would be that with normal commercial plans that most of us would be on, do they offer a GLP-1 now? Will they offer a GLP-1 in the future? And is supply a realistic constraint here? So you can't get enough of this on the Roe website. And is that like a problem that's going to be gone in 6 months and we'll always have adequate supply, or is there an actual supply problem with this drug? And so will our plan cover it in the future and make it free to us? And will it be available?
Well, the commercial plan side, they're very, very concerned about the cost. A lot of companies to retain and attract employees are saying they will include it in their benefit, pay for it. So the plan needs to be able to find a way to include that in its benefit design and its pricing and contracting with PBMs, as an example. So it's going to have a huge impact. About 25% of the plans presently support it, depending upon the employer and the employer's benefit structure and what they're willing to pay for and keep employees around. Obesity is a major problem. Diabetes is a major problem. Absenteeism, presenteeism is going to make a big impact. So GLP-1 is a game changer in the industry. It's made everything upset the apple cart. So if you're a digital therapeutic and you think you're going after diabetes, what are you going to do about it, right? Are you going to promote it? Are you going to be a telehealth solution provider to prescribe it? And how fast will it go to the market? I think the supply is a question of controlled supply to keep the price up. That's my perspective.
And we're seeing prices of $150 to $300 a month for the different drugs in this category. Assuming it works, it lowers someone's weight from, call it 250 to 175, let's say. Is that cost effective? Is it cost effective to pay for a payer to pay for that? And, and it somehow makes it up in lower healthcare costs?
Well, you have to balance the expense side, the risk adjustment, orientation and stars rating. Let's talk Medicare Advantage as an example, with the expected benefit design when it looks at downstream expenses. So if they weigh the benefit design with increase in star ratings for member satisfaction as an example, with the lowering of overall costs, then they have to figure out what other benefit they're going to take off the table to pay for the Wegovy or GLP-1 and perhaps a dental benefit for that matter. Everything's on the table. So they have to balance the risk adjustment stars rating with in the Medicare Advantage as well as in Medicaid. So all of these things are going to roll together. And when you look at a particular commercial plan, since the industry has adopted these CMS ratings, universal function, as well as NCQA standards, the HR department and employer needs to look at those two to see how it measures its own success in regard to payments to providers. So it all comes down to what you can afford and can't afford.
Thanks. And so, by the way, for our audience, we're still getting used to having moved our tech stack from Callin to Riverside and LinkedIn. And what I'm noticing here is that on LinkedIn, we have a comments section, and it's a little different. Formerly, we had a chat room. And now instead we have a post on LinkedIn, which holds streaming content. And then we have LinkedIn comments under the post. And so we welcome comments from our audience. It's a lot like a chat room, but it's actually a comments section, which is slightly different. But we would love to have your questions. And right now we're covering trade journal stories and business news. And so if you have any of those, feel free to type them in the comments, and we give priority to audience questions. So the next story is GE Healthcare, which is a spin out of GE from 2000, has acquired MIM Software, which is an AI and imaging solutions company. The financial details were not disclosed, which usually means that MIM was a pretty small company. MIM Software has FDA-cleared radiology support software to view data and images used in diagnosis. And the CEO of GE Healthcare is Peter Arduini, and this is their third acquisition in a year since they were spun out of GE. So big picture, I think that spinning GE Healthcare out of GE was a good thing for our sector in general. It allows the company more independence, and it means the final decision maker is the CEO of GE Healthcare, not the CEO of GE. It allows it to raise its own money, among other things, through external processes. And now we see GE Healthcare being a relatively active acquirer in the time since it was spun out. So that's great news. I know GE, when GE Healthcare was part of GE, it was known for not being a particularly creative or inventive acquirer, and also for making, I think, lowball offers in the sector. And so it's yet to be seen, but in general, giving autonomy to companies in healthcare is a good thing. And having a company that's made 3 acquisitions in the last year is a good thing. You could imagine GE Healthcare being a major consolidator in the sector and young companies having more options because GE Healthcare is out there. Also, there's been under acquisition, under consolidation in our sector for 15 plus years. And now I have a big view out there that we're going to see it pick up a lot in the next year. And for 15 years, it's been under consolidation, except for 2021. That was the only exceptional year. And so I'm predicting in this year and next year, we'll see a big uptick in consolidation in multiple sectors, including in provider tech. And these deals are in provider tech. So this is part of the cutting edge there. I think that the GE's deals, along with Veradigm acquiring Science.io, which was an AI deal in this sector, are examples of what we're going to see more of in the provider tech sector. So, Dutch, any thoughts on this story?
Well, I believe you're right that there has to be a consolidation in the industry. As I went to the health event, HLTH event in 2020, I was shocked at the amount of startups. Took it up a third of the floor. And when you ask them who's their persona or buyer, they couldn't tell me who they were actually trying to sell it to or what the value was. So I think it's good for consolidation. It's good, the rates up and everything else. It's good for the consolidation. I think that they'll find value in combining certain solutions. To me, there should be more of it. A lot of Me Too solutions out there trying to bang on the same door. I think if I look at my prospects and my customers, they have to be polite, and they probably take at least 1, if not 2, vendor calls a day to be able to say, hi, nice to talk to you, see you later. But it's part of their politeness and part of their effort to be good in the marketplace and listen to other people. So you need to be really sharp about what you're saying out there. I think this GE, formerly the GE Healthcare, back to that topic, had been focused on its big iron. And now it's got to be able to figure out how to optimize not just the iron, but the processes within their customers' bases. Hope that helps.
Thanks. And we have a question from Jacob in the audience, and he asks us to comment on big problems in the genetic testing industry. So Invitae went bankrupt last month, and 23andMe, there's a report that he points to that they face declining revenue. And so any thoughts about that? Well, I'll just comment, first of all, this is bad news. There's different parts of digital health, and one of the parts is testing, and testing does not get a lot of love. So our system doesn't pay a lot for testing. Our system pays for interventions and drugs, and not for testing. And so, and these are some leading companies in the sector. Invitae is a lab testing company that has genetics testing and other testing. And there was a lot of hope around what they had to offer. So first of all, most tests we take are not genetic tests. The tests say, do you have strep throat or not? Nothing to do with genetics in that. So there was a great hope that by giving doctors genetic testing, they could directly infer and learn a lot about disease from that. That has not panned out as well as people hoped that it would. The story I hear from people in the industry is they say, we decoded the genetic code and it's all spaghetti. We learn things and it's all much more complicated, more indirect, doesn't translate one-to-one to results than we thought. And therefore, it's not, if only, it's rare to come across, oh, you have this gene, that means you will have this disease. It's rare to find that. Instead, there's overdeterminism. There's many factors involved. It's an indirect link, etc. That's the spaghetti part of it. And so Invitae also had a consumer angle to it that was very interesting, but I think they missed the boat on that. Companies like Let's Get Checked and others seem to beat them to the consumer market. They also they were very importantly, they were a central lab. Most labs choose a strategy of locating as close to major providers like hospitals as possible. They were a very centralized lab, meaning you have to send your sample across the country. And that has some benefits, and has some drawbacks as well. But putting your lab close to a provider, sometimes that meets other needs of the provider, like convenience and speed and that sort of thing. And so, in general, I'm not sure why both these are having trouble at the same time, but this is an area that, it's sad for the sector that these two particular companies, are having the trouble that they're having. And I'm not sure exactly why they're both having problems at the same time. I think 23andMe, very innovative company. I think they also missed the boat a bit on, they were in a position there's been a phenomenon in COVID of people not going to their doctor's office for tests and not going to local lab companies for tests, but having tests mailed to their home. And 23andMe, and that's like Let's Get Checked, and also Everlywell. And 23andMe pioneered sending tests to the home, but they missed that market. And so had either of these companies won in that market, they wouldn't be in the situation that they're in today. They probably didn't define their business as being in that, and it wound up being one of the biggest that they could have possibly gone into. So any thoughts, Dutch, on this? I'm sorry I don't have any more insights.
Well, there's a couple of angles on that one. My personal opinion is the testing, genetic testing is great for the box manufacturers, Illumina, the other ones like that. Obviously, the big kickback for Illumina was the inability to merge with Grail. There's a lot of support in the commercial side for genetic testing by the large employers. There is some belief that they can get ahead of the curve when it comes to costs. As you can imagine, the last 5-6 years, oncology is one of the largest drivers of costs in the industry. And they're trying to figure out a way to reduce that and optimize around providers to provide a full suite of care, from the genomic testing through to the optimization of treatments for that, and trying to find a way to reduce the costs. $1 million oncology drugs are very, very expensive right now, so they're looking whatever they can. So health plans are still promoting those service sets to be able to pay for, in part, to not only reduce their costs, but also their members, their customers' costs. So I think there's still a market for genomic testing, as long as it's focused and provable and doesn't upset the supply chain apple cart.
And Patricia's asking, was I saying that I think that MIM was bought at a low valuation by GE Healthcare? And so, no, what I was getting at was that, so I don't, first of all, press releases said that GE did not reveal any information about the transaction, neither did MIM. What that usually means is that MIM was small compared with GE. And specifically, it was less than 5% of the size of GE Healthcare. And so that there's what's called a standard or a threshold of materiality, which is usually held to be about 5%. So if an acquirer makes an acquisition that is less than 5% of its own size, it has no particular duty to explain anything about the transaction, because it's not material. However, if it's more than 5%, then it may need to justify to its board, to other parties, shareholders, the public, the terms of the acquisition. So it just meant, it doesn't mean that they bought MIM for a low multiple. It just means that MIM was probably small compared to GE. There could be other reasons why terms were not disclosed. It could be, a purely private matter. There could be other reasons as well. The next story was Otsuka and Click announced that they had received clearance from the FDA on a new prescription digital therapeutic called Rejoin for major depressive disorder. Rejoin is a 6-week remote treatment program, and the product will be released to the market in the second half of this year. So I think this is really great news, but it's in a very troubled sector. So the sector of prescription digital therapeutics, which is taking this IP for therapeutics through software and putting it down the prescriber pathway with FDA clearance as software, as a medical device or some other regulatory category, it raised a lot of money. And then we had, of course, the well-publicized bankruptcy of Pear and also the shutting down of Better Therapeutics for diabetes. Pear was for opioid abstinence, and then you had Achille, unfortunately, announcing that it was going to cease selling down the prescriber pathway and focus instead on the consumer pathway, which I think is a defeat for the sector. And so basically, there's never been a hit product in this sector, despite all of the investment and all of the hope in this sector. I do believe that there's a promising future for this sector for a number of reasons. First, the modality of software is very different than the modality of, say, large molecules or small molecules. And there are conditions that would be better treated by software, such as cognitive behavioral therapy treated conditions, than they would be by a small molecule drug, for example. So there's possibility there. Another issue is that there is just not enough trained professionals in areas like mental health today and in the future. And that gap between skilled labor on the one hand and patient need on the other hand is going to be filled by software. And then a third reason is I think that pharma is ultimately going to see prescription digital therapeutics as being like their other drugs. They're going to see a sales rep holding a bag. In that bag will be a small molecule drug, a large molecule drug, gene therapy, and a prescription digital therapeutic. And so I think as a category, they may wind up looking more like medical device, which is lower margins than biotech, unfortunately for the category. This is great news in a troubled sector. Right now, it's very hard to raise money of any kind for prescription digital therapeutics companies. Click raised a lot of money, a huge amount of money, hundreds of millions of dollars during the good years. And I'm glad that they are still around and they're investing it in this kind of a product. I think the products have run into trouble in two major ways. The first is that they're harder to use than pills. If you think about it, nothing in the world is easier to use than a pill. What do you do with a pill? You take a pill and you put it in your mouth. And so anything that involves an iPad or a multi-step software process or whatever is going to be harder than, and so there's usability issues. It's less usable than pills. That's one problem. Second problem is market access and reimbursement and adoption by prescribers and patients and reimbursement by payers. And that's tougher. So the easiest path for that is to have a new molecular entity in biotech for an unmet medical need. You get all of those things handed to you. Anything else less than that, and you have to fight a battle to get prescribed by prescribers, reimbursed by payers, and that's just been tough for them, much tougher for them. So, but I'm glad to see we have another drug cleared by another prescription digital therapeutic cleared by the FDA for a major issue, for a major depressive disorder. So any thoughts on that, Dutch?
I've sold a lot of digital therapeutics into the pharma industry, and I've seen them bang their heads against the table. But ultimately, the end is, do they have access to the customer? And is the health plan willing to pay for it? And or jointly distribute it to a subsector of the population to live and learn about what that member can and cannot do, and alongside the drug, and or taking the drug alongside a digital therapeutic. In some cancer drugs, they use the pen, and the pen is linked through Bluetooth to the phone, and you can get some outcomes and outputs that way. But in the end, it's very, very difficult to pair the action of the member or the patient to the drug, to the phone, and gather efficiently information that relates to all the other aspects of human behavior. It's very difficult. And so it's a stretch, oftentimes, I've seen for digital therapeutic solutions, such as those that pair the drug to the particular medication and therapy approach. It's a hard road. It can be done. There are ones that are specifically, I would think, in the oncology region that are very, very good. So I would want to dig deeper into that question on that side of the house versus the mental health side, because you've seen the struggles that these firms go through. Although, if they pair it If you look at some of the universal design stuff coming out of CMS, they are trying to pair the outcomes of populations directly to a HEDIS score or a HEDIS-like score that relates to stars and CHAPS. So I would make sure that I'm going to get reimbursed in it 1, 2, 5 years down the line.
So we have some comments from Patricia and Jacob about acquisitions in the sector. So for the last 15 years in digital health, we've had under consolidation and under shakeout in the sector. And I have a thesis that we're going to really see change, and we're going to see a lot of shakeout. Shakeout is when some companies in very competitive markets wind down. So you have a subcategory that has 7 well-funded venture-backed companies in it, all doing the same thing. And you could expect to see some of them shaken out who are not market leaders in that scenario, and also consolidation as well. I think what we didn't understand in the recent past was that the reason we had under consolidation and under shakeout for so long was that we had zero interest rates, basically. And so in that environment, young, fast-growing companies command huge valuation multiples for their growth. And then because of that, they're not attractive acquisition candidates by consolidators. You have a young company growing top line at 100%. You have a consolidator growing top line at 10%. The young company growing at 100% has a valuation level at 15 times forward revenue. The mature consolidator is trading at 8 times forward revenue. And they're just not interested in buying such a highly valued company, and they can't make it be accretive to them, which means increasing their earnings per share in the future. This is now sort of right-sized today, so we're going to start seeing more acquisitions, I believe, because it used to be young companies could raise any amount of money. Now they can't raise money. It used to be they traded very high. Now they don't trade very high. Consolidators can still raise new money to get deals done, and the valuation levels are more in balance to make acquisitions work. So we're going to see more of this. And what you're going to see is a platform company that's an incumbent, that's a consolidator with suites of products and a great sales force to the customer and access to capital markets like they're public and have a decent stock price and that sort of thing. They're going to have money to go buy point solution companies that are no longer trading in the stratosphere. And in that case, it may be common for them to buy companies that are less than 5% the size of the consolidator. That could certainly be quite common. And they're talking, so that the consolidator is talking to its buyers, its product buyers in the marketplace. And those product buyers are saying, we want to buy a consolidated suite from you, and you're missing a product. And so then the consolidator goes looking in the capital markets to buy a young company that has that product. They can then instantly sell through their sales force to their software buyers or whatever. And that company could easily be quite small compared to the consolidator. It could be 5% or smaller. Let's see. So we're coming up against the halfway mark soon. So let's see. Pelago Health. I was very pleased to see that Pelago Health, which is a substance abuse virtual rehab clinic, this week raised $58 million, Series C round. They focus on tobacco, alcohol, and opioid addictions. The CEO is Yusuf Sherwani, who's in New York. They were backed by Y Combinator and Startup Health. The company sells through the employer channel. That's interesting because this is not employers love to get involved in diabetes, hypertension, but they are less active in getting involved in tobacco, alcohol, and opioid addictions for employees. So here's a company that's figured out a way to capture that. I heard they have over 100 enterprise customers. That's probably, I'm guessing they sell to large employers, so 100 large employer customers. So that's a great story. And they were backed by Y Combinator and Startup Health. Investors include Atomico, Kinnevik, Octopus Ventures, 8 Roads, and Gray Matter. So this is one of those interesting stories to bring to our audience. This is not a classic venture syndicate. So one of the few deals announced this past week was backed by venture investors who are not mainstream digital health investors. And that seems to be a common theme the last 2 years, is that the mainstream digital health investors who have raised funds and made whole careers out of investing just in US digital health are sitting on the bleachers still. Lead investors are not investing. So just to go through some of this, This is a Y Combinator company. That's pretty rare in healthcare. It's nice that a Y Combinator company has been this successful to make it to round C. That's pretty rare. Startup Health, that's actually is a mainstream player. They're the biggest and most substantial accelerator in digital health. But then Atomico, not a mainstream digital health fund. Kinnevik, Swedish and not a mainstream US digital health investor. Octopus Ventures, this is Britain's leading digital health venture fund, but not, the company is primarily US based. Eight Roads, not a mainstream US digital health fund. Gray Matter, not a mainstream US digital. So this is a syndicate that has been pulled together that is not a digital health syndicate. And many US digital health companies have had to go find their investors elsewhere. And this is another example of it. It's also an example of the move to tech-enabled services, virtual care, hybrid care models, new care delivery models. We've seen a lot of investments in this area, remaking healthcare, not by being a software company selling software, but by being a clinic selling care. And so this is the nerds and the black turtlenecks taking on the white coats, and the black turtlenecks are winning. And the white coats are terrible buyers and users of technology, which is where the market opening comes from. So, Dutch, any thoughts on this deal?
In all virtual solutions, the question is, how do they arbitrage between wanting a customer to come to the telesession and providing that they don't get too much so that their cost structure doesn't get out of place. So the interesting thing about this is that there is a significant demand on the commercial side as well as on the Medicare and Medicaid side for providers. There's just not enough of them in the world. And so the supply-demand constraint is a major issue. And they are filling a niche here, which is in the market at this moment. So I think if they figure out a way to include the drug prescription or not in that model, it might work. It goes along with the potentially next one. There's a lot of PE money going after the in-clinic solutions as well for mental health. If you want to look at a company called the Braff Group, they have a report on for the PE industry and specifically in investing on location in-person clinics. It's very different and very insightful.
Thanks. So we have a question about prescription digital therapeutics from Zena, who looks like she works in pharmacy, which is great. And so do you see the prescription digital therapeutics sector as a pure play therapeutic, but eventually seen as another therapeutic modality? Yes. So big picture, the first therapeutic modality in terms of say, drugs was 1870s. It was small molecules, organic chemists making things like aspirin. Then in the 1970s, there was large molecules, biologists making things like human growth hormone with the birth of genetic and the U.S. Biotech sector. And then gene editing came along as another modality. It's had an on and off history for the last 20 years. And finally, prescription digital therapeutics software as a modality. And yes, I think in the future, software will be just another modality of therapeutics, and pharma and med device will have bags with products in them, and prescription digital therapeutics will be those products. And there are standalone therapeutics. There are also companion apps, which is a little different. And there's also paired drug software combinations. And that is like having a mental health drug and a mental health app going through the FDA trials together and used in a specific combination with specific claimed benefits. So I think that is very promising on an effectiveness basis. It may not have a good business model. What we're seeing over the last 10 years is that it is not as attractive a business model as biotech. Few things on earth are as attractive a business model as biotech. I think biotech has higher margins than SaaS and higher margins than the illegal drug industry. Don't have as good a business model, partly because we haven't been able to charge as high a price for them and they haven't been adopted as well as biotechs, and also they are more expensive to sell and to train people to use. and they have much worse IP protection than biotechs. You can have a fast follower come in. Someone can do pioneering work in prescription digital therapeutics for diabetes, and then 2 years later, you can have a fast follower come in and wreck everything for the pioneer. That doesn't happen in biotech. And then she says, who trains the patient on usability? Well, this is one of the issues, which is let's say you're a doctor who's a prescriber, and you're going to and a mother and child come in, and the child is supposed to be prescribed a drug for ADHD, and you prescribe Achilles for them, which is a prescription digital therapeutic. And then this is just all hypothetical, but let's say that later, that mom is calling your front office saying, how do I set this up? How do I get Wi-Fi access for an iPad in my home? How do I get this working? It's broken or whatever. And then the mom and kid come back in later. And first of all, the doctor's staff wasn't ready for this and doesn't want to do this. And second of all, then the doctor looks at adherence measurement, which is perfect. Achilles has perfect adherence measurement. And the adherence measurement, so most people's drugs do not have any adherence measurement, but Achilles has perfect adherence measurement. And the doctor looks at the adherence measurement and it's terrible. The kid's not using it. How likely is that doctor to prescribe it again? It was a lot of work, and then it turns out the kid didn't use it. That any kind of training of the prescriber and the patient's parent or whatever has to come out of the margin of the drug, making the drug much lower margin to the investors who invested in it, which is not good. So let's see. So Michael in our audience says first successful PDT development agreement between a pharmaco and software as a medicine developer, Click-Otsuka, is certainly a milestone. Thank you, Michael. So let's see. Moving on, Dutch, why don't we skip to conferences that are coming up just for time reasons. So for our audience, feel free to comment on conferences that you're going to or that you want us to review. I'm going to throw out there. So the National Business Group on Health Conference is coming up, their annual conference, April 9th to 12th in Arizona. Tickets are about $1,300 for members and $2,200 for non-members to go. And this is a great conference if you sell to progressive large employers. This is their annual conference. And this is a conference that is not overexploited by vendors yet. It's not oversold by vendors, in my opinion. And so you can go to this conference, and first of all, if you walk the expo floor, you will learn an enormous amount about competing vendors in all kinds of subsectors. It's great. Second of all, if you sit down at lunch, you're going to be surrounded by people who work in HR at progressive large employers. They're the ordinary attendees of this conference. You're going to get the benefit leader whose job title is Senior VP for Benefits and Compensation at Activision Blizzard or whatever. You're going to get the other 6 employees in their office who work who touch this process. They're coming to this conference. This is their big fun event in a resort town in Arizona for the year. And so I would go. If you sell into large employers, I would talk to the National Business Group on Health and ask them to consult to you, pay them a consulting fee on who to sell to. I would try to present. I would get an expo booth at this conference. I can't recommend the conference high enough. I would seek to present. Now, to present, you have to have a member company, which is a progressive large employer, who has successfully used your product and who wants to tie their career to you and co-present with you. They won't let you present it unless you can do that. That's a high standard to meet. But I would try to present at this conference as well. So Dutch, any thoughts on this conference?
No, I think you're right. It's a good conference for those to go to. The other one that relates to that is the HFMA conference, which is a Health Finance Management Association. And the HR reports to the CFO. So you're going to get a lot of good ideas there. I would also go into the union conference. There's a union conference. It's annually done at Las Vegas. It's a pay to play, but it's a very good place you can find opportunities into those sectors that have unions, such as SEIU or the hotels industry, that kind of stuff. So it's a very, very good area that relate to getting your product out there, understand the customer, get really close to the prospect, and you can ask a lot of questions. It was very, very good.
One of the somewhat disappointing lessons I had from going to the National Business Group on Health annual conference is that as a vendor, you have these edgy, cutting edge, sophisticated solutions that might involve using software, wearing an activity tracker, using software, calculating things, whatever. And then you talk to the buyers, and they are not especially sophisticated, and they don't have a highly sophisticated view of their own employees. And so basically you have to keep it very, very simple to sell it to this audience. And in a sense, a lot of very complicated, sophisticated products don't work well. They get lift from investors and in Silicon Valley because they're differentiated and sophisticated, but they may not sell well to employees of large companies. Anyway, so I would also, let's see, we have a Jacob in our Q&A asks about HIMSS Rome. So I have not been to HIMSS Rome. It's hard for me to evaluate it. But HIMSS is fundamentally a group of U.S. hospital CIOs. So presumably HIMSS Europe is a group of European hospital CIOs. So if I were selling to European hospital CIOs, I would go there as a trade show in order to meet software buyers, hospital CIOs. Now, in the US, HIMSS to me seems like it's a bit on the downward slide as a conference for a couple of reasons. It's very hard for them to get past their founding mandate of focusing on hospital CIOs. They're trying to do that by focusing on payers, which is a totally different area, and also on innovation. And that's what Health is doing as well. So the two of them are going at each other. And that's also what Vive, which is owned by Health, is also doing. But at HIMSS, you cycle back 15 years ago, and you would literally meet a hospital CIO walking the floor, and you would get a meeting with them. Now at HIMSS, you can seldom do that. The prices at HIMSS are very high, and you can seldom meet the hospital CIO unless you're already a big vendor selling to them. So is it different in Europe? I don't know. But if I were a European company selling to European hospital CIOs, I might go to HIMSS. I wouldn't expect American hospital CIOs to go to HIMSS Europe. Therefore, if I'm an American digital health company selling to American hospital CIOs, I wouldn't go to HIMSS Rome in order to meet with them and sell to them. So that's my thoughts.
Steve, if I may, I think that HIMSS has regional locations, and if you're a young startup and you're trying to learn, you get a lot of different types of characters who go to those things for themselves, for their interest in overall in technology and their personal interest in helping people. So if you go into regionals, yes, it's a good networking opportunity. Are there buyers there? That's a different question.
So someone in our audience asked the conference we've talked about. So far we've talked about the National Business Group on Health Conference, April 9th to 12th in Arizona, and HIMSS Rome coming up. And the next conference I'll bring up is BioIT World Conference and Expo in Boston, April 15th to 17th. So this is the largest and leading conference that is a pharma tech conference focused on the pharma discovery and early stage drug development sector. So this is, and their theme this year is AI for drug discovery. So this is a great conference if you're in that sector, selling to that sector. This is like, combinatorial projects where you have AI, developing shapes of molecules in the body that have a disease issue with them, and then molecules you could put in the body, you could develop and put in the body that would then either promote or inhibit the molecules you're seeking, the body's native molecules you're seeking to address, and other issues like that. So this is going to be fun. This is a fun group of people. It is a professional education conference. It's also a trade show conference. So if I were in the pharma tech industry selling into the early stage drug development and discovery sector, this would be probably my number one trade show of the year to go into. This is also an area with a strong budget. Every part of health tech feels poor right now. But on a relative basis, pharma is only a little bit poorer now than it was a few years ago, whereas places like hospitals are a lot poorer than they were a few years ago. Health plans are a lot poorer on a tech budget basis than a few years ago. But pharma which is usually the richest and spendiest of them all, is only a little poor. I was at a pharma tech conference recently, and I mentioned that pharma is relatively better off than other tech buying sectors, but they are noisier about their problems than other sectors are. And immediately the person I was talking to responded and said, well, that's the agencies complaining. So pharma has these people called the agencies, the, creative agencies that are very loud and chatty and talkative, and they're being hit by leaner pharma budgets for agencies and tech as well. So for this conference, by the way, the BioIT World Conference, tickets are about $2,000. And I'm actually going to be hosting one of my digital health receptions at the party. The theme for that night is what does big pharma, for our party is, which is going to be on Wednesday, April 17th, is what does big pharma think of BioIT? And I got a discount code for my audience if you're thinking of going to this conference, which is IVP Social. So the conference is a 3-day conference, April 15th to 17th. My event is on April 17th at the Boston Omni Hotel, which is where the conference is. And the third day, they're calling a Business and Deal Makers Day. The first 2 days are more professional education days, but the third day, they're calling a Business and Deal Makers Day. And so that's the day I'm going to go to the conference on that day. I'll see you there. And I'm hosting my reception there on that day as well. You can find my reception at stephenwardell.eventbrite.com. That's my Eventbrite page. And you can also get a discount if you want to go to the Dealmaker Day. Discount code IVP Social. Dutch, any thoughts on BioIT World?
I think it's a good one. I think you got to get there to be able to understand what's going on. There's going to be people searching for opportunities. Whenever I've gone to that in the past, there's another one, Medical Device Manufacturers Conference. There's some good R&D sessions you can attend there. You can listen to people who've actually implemented and sold it into hospitals as well as, payers. So, there's that one too.
So, and Alan in the audience, he mentions that Vive is now associated with Chime. Chime is a nonprofit association of hospital CIOs. And they are sort of a nonprofit competitor of HIMSS, which is a different nonprofit of hospital CIOs. So, Dutch, any conferences that you're going to or that you want to call the attention of our audience to coming up in the next month or two?
Well, I'm attending the Becker's Healthcare Conference next week in Chicago. Depending upon your product, you definitely want to go and focus on the Medicare, Medicaid conferences. That's a long ball sale. You have to be really ahead of the game there. The HFMA conference, future, we're attending a bunch of them from Wobot that relate to mental health. You want to go to the ones where you want to focus on the P&L owner of, or person who has got P&L ownership of a particular line in a health plan. So that's your focus. Now, AHIP is always a good show. It's been going down for the last few years. But if you get a chance to get there and you actually know something about benefit design, that is where they do talk about what they're going to be doing in the next few years. If you're lucky enough to have a customer with a plan, you get on you get a pay-to-play opportunity to be able to present. I think it's still a relevant conference. They do small ones that relate to digital health. Those smaller ones, you can actually go and talk to someone and bump into in the hallway, get a conversation going, have a small bar thing or whatever. So I'm still a fan of the smaller is better conference, to be honest. Most everybody here, than the bigger, flashier ones.
That's interesting. By the way, you're my first guest who has either has that opinion or voiced that opinion. That's really interesting. So maybe like HIMSS is a national nonprofit that has a central nonprofit and then regional nonprofits. So would you go, you're Boston-based, it's lower cost and more convenient to go to the New England Regional HIMSS conference. Would you say that could be, a better opportunity than could go to a couple regional conferences instead of the big annual one?
So in the health plan sales, you can go to there are regional state health plan associations. And I'll give you an example. If you go to the one in New England that it handles, or New York, you will be able to meet the executives at those plans or at the bar, and they're all there. I mean, the heavyweights, the head of sales, perhaps a president of a plan, they'll be there because they invest in the association and they all know each other. So if you want to go to a plan that you can really have an impact and get to see people, meet people, that's the way to do it.
That's great. Well, let's see. So personal notices. This is just if you want to connect with our audience somehow, you're going to be speaking on television or publishing a book or whatever. So my personal notice is that I have a drinks. I have a couple of drinks nights. One of them will be um, one of them will be Wednesday, April 17th at the BioIT conference in Boston. But you can check out my site, stephenwardell.eventbrite.com, and you'll see the upcoming ones in Boston. And I'll be there, and I hope our audience who's in Boston will come, and I'll see you there. Dutch, do you have any personal notices?
Well, we do have, I love following you and Tom Hardiman, great thought leaders. Just from a perspective of Wobot Health, we do have a fantastic podcast for the industry hosted by Chris Hempel. If you're looking for insights of what's going on in this particular niche, that one is probably one of the best. It's got a high degree of following, and the quality of information coming out of that is very, very high. So,
and Wobot is a software company in mental health. So, right. So you would be addressing the mental health side of things, but then also how to use technology and software to solve.
Well, it's the plans and our providers or thought leaders, policy leaders talking about a variety of different things that relate to mental health, but also SDOH policies and relate to CMS, that kind of stuff.
That's great. Well, so now we move on to our main topic, which is healthcare go-to-market strategies in 2020. So, and we're going to focus, when we say the word healthcare, we're going to focus now on payers and providers. And so I guess my first question is sort of what are hit products today? Where is growth today in selling to payers and providers? Where is growth going to be tomorrow?
So you're asking me, right? So the hit products, obviously the market mover was GLP-1 this year and last year. If you look at the health plans, what they're actually worried about, you'll actually understand what the concerns are. What are the top three? It's always going to be the ones that pushes the costs. Cardiovascular, oncology, diabetes, and mental health are the top 5 categories. So what are those that you're going to be able to do to bring to a health plan or to a provider that's going to increase their revenue, decrease their costs, and have something for each constituent buyer? So if I'm selling to a provider, I make sure that there's something in it for the actual provider or staff to achieve some kind of incentive payment through the provider contract with a health plan, as an example. If I'm selling to a health plan, what is the achievement to reduce costs, increase efficiency, and create a value for the health plan and the member? So those, when you look at products today, you have to focus directly on those value propositions. So there is a push in the health plans to improve the rollout for gene therapy. It's not the top, but it's in the top categories. Also, food for pharma, around that category as well.
So what's going on in the minds of payers and providers right now, especially when it comes to buying software and buying tech? So I'm hearing that providers just feel a lot poorer. They don't have a lot of cash right now to buy tech. And then within that cash budget, a lot of it's locked up with their primary EMR vendor, meaning that there's even less than their peers for new tech from new vendors. And then with payers, they seem to be panicked about changes in Medicare Advantage and plan ratings and that sort of thing. But what are some of the issues going on in the lives of payers and providers who buy tech right now?
Yeah, I'll start with the provider side. The providers have a diffused budget, right? So there's only a few people inside a provider that actually have budget, and they're usually focused on efficiency questions and for effectiveness of qualitative delivery. And it's very difficult to get inside the business processes by niche in the hospital, by body part, as an example. And in the payer side, the largest question payers have is, can I trust you? How long are you going to be around? Are you going to be there when we have to go live? Are you going to fix my problems? Can I come back to you and negotiate again how we're going to improve the outcomes and or reduce the costs. What has happened in the payer side is that we've entered into what I call the digital health trough of disillusionment. And what that essentially is taking the Gartner model and understanding what they've had. They came out selling all these great ideas, consumer engagement is going to be fantastic. And that business model was too focused on upfront payment, as an example, rather than engagement and outcomes. They're very, very difficult at this time to be able to get value. So the payment models have changed from upfront to engagement metrics, and the plans have gotten smart about that. Plus, the question for a plan might be, well, if you get to bill for something, I can only bill a commercial entity for a actual event, utilization of a product at some point in time. And then I get to put on top of that my 5 or 8% margin and administrative expense for being able to cut the claim. So you really have to focus on that thing. So the question is trust. Can I trust you, this guy Dutch? He's going to be around. He's going to help me out. Do he understand my business? Does he understand my business complexity? Does he understand the business architecture of the tools that I'm going to deploy, or I have deployed, or do deploy into my customer base? That means in the context of diabetes management, are you a type 2, type 1? Do you fit into the consumer engagement models that I have? Can you actually deliver on getting it out to the member? Can I outsource the delivery of that to you? Can I trust you for the messaging? Does it integrate within the messaging I have today? A lot of very, very complex questions that go on there. So the biggest question once comes back to how you understand the prospect's enterprise. And if you're not empathetic to the complexity of their sale and complexity of their need to make a decision, then I don't think you're going to get very far.
So there's both a story and a joke going on right now in the world of digital health and AI, which is that the first big use of AI in healthcare of large language model, generative AI, is going to be hospitals using AI to up bill, and then payers using AI to try to understand all this billing. So there's going to be an arms race of AI on each side. Do you see that happening? Is that playing out?
Are you talking about prior authorization, utilization management, that category?
Also, it could be things like AI working with a physician on physician notes to ask about time spent with patient, severity level of patient, and other issues to make sure they're properly documented so that the provider can bill more for that patient.
Well, there's always lots to argue about, especially in the notes, right? And the question is can the AI pick up the non-structured information and make it billable? So generative AI came out and said, this will save a lot of time for physicians and all those different things. I think that's a big issue, right? But health plans may be just looking for time to figure it out, right? They may be just saying, no, we're not going to do this. They'll just say no. And they're waiting to understand the tech more. So there's two sides of that coin. I think that there's going to have to be something related to AI that talks about the patient journey in the context of AI and or prior auth utilization management. Can the AI improve the expectation for the member who has prostate cancer, as an example, and has to have so many appointments in the next 6 to 12 months? Can that be prior auth in advance without the provider having to go back and ask for authorization again? That improves efficiency and improves the member expectation or patient journey and patient satisfaction, as well as the physician satisfaction. So it's those questions you have to go after. What's in it for the physician and what's in it for the member to be able to have a better experience throughout that period of oncology?
So there's also a joke going around out there. There's a movie from 20 plus years ago, The Terminator, with Arnold Schwarzenegger. And in this movie, the Air Force builds a supercomputer to fight its war with artificial intelligence. But then the artificial intelligence wakes up and destroys humanity. And the joke I've been hearing is that the movie was wrong in the details. It's actually going to be a hospital billing AI that wakes up and destroys humanity, not an Air Force one. So we have a question from Frederick in the chat. So a few things health plans are talking about surge of improper billing practices, transition from IP and OP without commensurate reduction in cost, high cost claims accuracy, etc. So, thank you, Frederick. Any thought? Is that also?
Yeah, there's no doubt about it. The health plans have been able to smooth over their, not put the pricing on the website first off, and then at the same time say, oh, we're going to lower costs by going to outpatient. Well, if they have an oligopoly, it's very difficult to, reduce your costs when they're trying to push it out to a outpatient setting, and they still get the bill for the overhead for the entity and for the facility. So, yes, it sounds good. Health plans should complain about it. They have very little pricing structure in certain areas like Boston, pricing competitiveness, and it's like that across the country. So no matter, they may be more efficient in an outpatient setting actually for the hospital or the system than it is for the payer. So I agree with that statement.
So sort of official budget priorities in the first half of 2020. What are you hearing from hospital IT buyers like the CIO, the CFO, and from payers, plan managers, that sort of thing, about their official budget priorities for the first half of this year?
I think as you mentioned, those top 5, I mentioned already, those categories: oncology, cardiovascular, diabetes, mental health, are all the top things for all those areas. What they're all trying to do is reduce ED visits primarily. Hospitals as well as payers justify a lot of the digital health solution acquisition through the deflection from going to the high cost centers rather than and trying to keep them out. So whatever it can do to manage that time together with a member or the patient rather than going to those centers is very, very important. So from a budgeting perspective, they're leaning in. You should definitely look at what's going on at CMS and watch the impact of the legislation from CMS as well as from the government. So there's a couple of the Inflation Reduction Act had a huge impact on what's going on at the payer level and at the provider level, as well as the Parity Act that's gotten some juice in the last 12, 18 months. There are some trends that you have to keep an eye on. If the government gets involved in impacting the decision-making at these entities, then you have to be able to either help them make money off of that change in decision-making or help them reduce costs and make it more efficient in the organization. So from a budgetary perspective, I think that payers are going to look at how to optimize their workforce. Get an expectation of, what appointments are coming up, what are the human capital they're going to need to be there, and what are the supply chain requirements to fulfill that event. Are they double booking on purpose? All that kind of stuff is going to be very important to watch. Kind of like airlines.
Thanks. And from our audience, Vidar asks, can you explain the impact of price transparency on hospitals, the Department of Labor fiduciary responsibility on employers? Any thoughts on that?
Well, it's my understanding a lot of those providers regionally, tried to comply and then figured out that it doesn't help them. Though that be the case, when you talk about price transparency, I would ask you whether you think that United Healthcare already knows the price for all the contracts in the country on second billing. So you could say, it needs to be transparent in the marketplace, but who is the price transparency for? Is it for the member, the patient, or is it for the health plan? And I guess, when you look at that question, it's more of a policy question. I think there's a lot of health plans, health systems that are looking to, avoid a ding from the government. But I haven't seen a lot of in the health system have to pay that money at this time.
And thanks, Vidar. And for my own part, I am not hearing, I haven't been asking hospital executives about this, but I've also not been hearing them bring it up as a big issue in their lives. But it probably should be a big issue to consumers and policymakers because healthcare is some of the most non-transparent pricing in the country. There's a story that there was a doctor who was amazed because he came across in the toy store for his kid a Barbie the Doctor set, and it had a sign to put outside of Barbie's medical practice, which said, set a bone, $40, stitches, $20. And the doctor was saying, this is the first time I've ever seen medical pricing. Was in a children's toy set. And it gets worse than that the more you dig into the issue. So now, with our remaining time, I wanted to skip to just what are the best practices of go-to-market strategy? To think about selling into this sector, what should you be thinking of? What are the best practices to be successful in selling into this sector, payers and providers?
I think for go-to-market vendors, you need to think about which part of the enterprise you're impacting. So are you going to end up in a large plan? You have three components of the enterprise. You have the sales and sales acquisition eligibility side of the house, enrollment. Then you have the wellness component. Wellness could be diabetes management or communications around diabetes management. And then you have the care management side. And those are impacted by the MLR. So if it's sales and admin component, you have a 15%, very tight budgets focused on member retention and all that sort of fun stuff. But on the MLR side, which may include the wellness solution, you have to be able to justify it by cost reduction. So make sure you know which side of the house you're going to sell to. Then you have to understand the buyer persona, and also the complexity of those personas within the enterprise. Who has the budget? Who's new? Who actually has the wind behind their sails? You have to dig into the details behind that. That persona has to have four components: BANT, budget, authority, need, and timeline. You have to understand that very early on so that the person doesn't go to another plan, as an example. What kind of buyers are the payers? So my focus has historically always been on the SVP of sales, the P&L owner, or the side of the house that impacts decision-making, clinical leadership. And then underneath that would be influencers who are within certain sectors. Digital health innovation typically does not have a lot of money. So you need to go beyond that. There's a group typically called the Market Solutions Group within a payment plan. They're the people who look for products 2-5 years out, and they were looking for pieces, and they're working on the budget, and they do the portfolio rationalization. So you need to figure those people out. So from a go-to-market strategy, you have to have those things I'm just talking about. You start with, which part of the enterprise you're going to sell to, what is the persona, what is the BANT, what is the kind of buyer you're going to sell into. Next, you're going to have to run down what is the business and technical architecture that you're going to sell into. How do you fit into the solutions that may or may not be there already? How do you improve those solutions that may or may not be into that entity? Can you fit in seamlessly or not? And how easy or quick is it to implement? One of the more important things that we've talked about already is how can I trust you to do what you say you do? The last one is KPIs. There is a dirge of KPIs for digital health engagement. Will you go at risk if you cannot meet those engagement metrics? Can you get agreement for those engagement metrics or not? There's been a lot of people with a lot of hype around certain engagement metrics or KPIs. In digital therapeutics, the average KPI or engagement is somewhere between 8 and 10%. Now, if I was a health plan and I had 2 million people on diabetes and I wanted to focus on type 2 diabetes, if I got 8%, that's not very good return on investment, especially if you're going to pay $120, $120, $150 per engaged member over a short period of time. So you really need to understand how you're going to be able to improve those things. Are you going to nudge them? Are you going to help them feel better? What's the actual outcome? People argue about how deep should your value proposition be? 46 pages? You think an executive has time for reading 46 pages or attending a 45-minute webinar? I guess not. So you really have to focus on that. And what is it that you're trying to solve? So people come to me and say, so it's clinically really, really strong. Well, that's table stakes. Can you prove it? Do you have RCTs? Do you have that kind of thing to prove that out? What's this current state? Do you know my enterprise presently? And what would be the future state with your application? And then what are problems you're trying to solve? Can you do it effectively and efficiently? And what is the potential ROI? If you don't know the ROI, don't go grasping at straws and say, it's going to affect stars. We're going to make sure you're going to get a lot better, you're a lot happier. It's very difficult to reach for those different things if you do not know exactly what the law says or the legislation or what CMS is saying. You can fit it to something. Are you going to impact HEDIS scores? Are you going to be able to collect SDOH data? Are you going to be able to help that information get back into the analytics team for targeting, for member engagement? There's a lot of questions you got to come down. So last, on sales enablement, you have to have people understand the business. What are my problems I'm, as a health plan, trying to solve? What are my daily concerns? How do I fit into that daily concern? Am I going to help them in their day, or am I going to hurt them? What do I have to worry about? Health plans already in all these enterprises have thousands of solutions they're trying to manage. So how are you going to make their lives easier? Are you going to come in as a point solution? Are you going to come in as a collaborator? There's a lot of very, very important questions, and you should have that answer on 5 pages. Some people think you got to have, very little data on a deck. Other people think that you got to give them a lot. So what I'm seeing, you really have to figure that out very quickly, very succinctly, and not basically shine their shoes.
That's great. Let me ask you about, and by the way, for our audience, now's the time to get in any last questions you have for Dutch. Let me drill in on engagement. You brought up engagement. So I've been hearing about, and in an earlier life, I've been selling on engagement of digital health solutions, but been, for 15 years, and everything's digital these days. Digital is probably better than pre-digital. What was pre-digital? It was phone call centers and mailed brochures and that sort of thing. But digital had this incredible promise of engagement, and that promise was that digital can be mass personalized. That's one of the promises of digital. And digital can be gamified. That's another promise of digital. And digital can be on a smartphone. And digital can be social. Digital can tie in your adult daughter in California to your care. And digital also can be based on a cell phone app. Now, cell phone apps could be very special because it's always within arm's reach, and it's always connected, and so it can buzz you and remind you to take your medications, or it can remind you to walk or something, to do more steps or whatever. So all of this potentiality in digital in healthcare for the provider and for the payer. But now, 15 years later, I just get the sense of disappointment that with all that potential, it hasn't delivered. And I've heard numbers of engagement percents more like 5%, which is a little lower than what you were citing. And why do you think that for many vendors and also the administrative users of this at providers and payers and the ultimate end users, why is it slightly disappointing as a sector? And do we still have more promise for the future? Can we get it up? Where do we have an opportunity to boost it further?
Do you think a digital innovation tool is going to be as good and sticky as Amazon? If you have that expectation, you've got to go back to the farm, so to speak. There's no way that a digital health solution is going to be as sticky as an Amazon. And by the way, do you spend all your day on Amazon looking and flipping through books or trying to find something? No, you don't. So it's a bad comparison, in my opinion. Then everybody decided to adopt this NPS scores. Well, that's all good, right? But we're humans, and we're difficult, and we're never going to be perfect from an engagement. Now, I started out selling consumer engagement stuff to health plans, and we did a great job. We took the average time a person spends with a health plan from 3% up to 15%. Being able to come back and get engagement. That's a huge swing. I think what's happening now is that the average digital health solution does not share with the member, if you know me, show me. Now you go to Amazon, it says, well, I know what you're looking for, right? And they show you pretty darn quick. But a lot of these digital health solutions are not doing that yet. They're not showing me that they know me. That's a complex question. But the plan or the digital health solution needs to figure that basis out. Not just the member, but it has to have something for each constituent in the health plan cycle. So hypothetically, if I want to be a digital therapeutic, do I get prescribed or digiscribed somewhere? Could be a call center, could be a PCP, could be a specialist. If that's the case, what's in it for the physician? If you got nothing for the physician, they're going to be like, oh, this is nice. Thank you very much. I'm not incented to give someone something without something coming back? How am I measured? What's my comp? The same thing goes true to the health plans. They really want to know that you're in it, not just for the member, but to improve the outcomes and to be able to have measurable impact. And a lot of them just go down there and say, well, it's they show you all the stats coming out of the product, but are they helping the member migrate the workflow, migrate the entities? So if I'm in a health plan and I use a digital app, and let's say it's a diabetes app, during the workflow of using the app, does it say, hey, you know what? We just have a benefit. And the benefit is if you use this app, we'll reduce your premium. It's in the app. It tells you in the app. The average people say, that's not very good. You don't do that. I mean, it's crazy, but that's the kind of thing. You've got to link the knowledge of the member's needs to the app. I'll give you another example. The Medicare Advantage switchers, that is, if I flip from one plan to year as a Medicare Advantage member, I'm flipping because I have very little money or I have problems with mental health. So you really have to understand what's going on with that member. So if you're not addressing that, so if I'm a Medicare Advantage plan and I'm not addressing that population, I lower my member retention, correct? So you really have to lean into those questions. I hope that helps, Steve.
Yeah, thank you. Well, good, Dwight. I think that's all we have time for. So you've been listening to Digital Health Investor Talk.
Thank you all. Have a great day.
Stephen Wardell. Our thanks to our guest, Dutch Dwight. Our next show is Wednesday, April 10th at 4 p.m. The topic is the good, the bad, and the ugly of AI in healthcare. With our guest, Dr. Ron Razmi, who has just written a book on AI in the hospital. And for our Boston audience, I hope to see you at our next Digital Health Innovation Night on Thursday, April 11th from 5:30 to 8:30 at the Liberty Hotel in downtown Boston. Our guest will be Sean Cheng of Ascension Ventures, and the theme is the roles that AI will play in the hospital. Look forward to seeing you there, and you can find a list of upcoming shows and events at Stephen. You can also follow me on x.com. So thanks very much, and thanks for joining us, Dutch.
Hey, great to see you all. Appreciate it.